This is Economic Foundations, Episode 6. Foreign exchange and macro, capital moves, currencies adjust, economies compete. Today, we define the global framework. Foreign exchange, FX. Foreign exchange refers to the market where currencies are traded. It determines the relative value of one currency against another. Exchange rates fluctuate continuously. FX markets operate globally 24 hours a day. Currency value reflects economic strength and policy expectation. Exchange rate. An exchange rate is the price of one currency expressed in another. If $1 US equals 1.30 Canadian dollars, that is the exchange rate. Exchange rates influence trade flows, inflation, corporate earnings, currency pricing affects global competitiveness. Currency appreciation. Currency appreciation occurs when a currency increases in value relative to others. A stronger currency makes imports cheaper. It can make exports more expensive. Appreciation may reduce inflation pressure. It may slow export growth. Strength carries trade-offs. Currency depreciation. Currency depreciation occurs when a currency loses value relative to others. A weaker currency makes exports cheaper. It increases the cost of imports. Depreciation can stimulate trade. It may increase inflation risk. Adjustment alters balance. Trade balance. Trade balance measures the difference between a country's exports and imports. If exports exceed imports, the country runs a trade surplus. If imports exceed exports, the country runs a trade deficit. Trade balance influences currency demand. Global exchange is interconnected. Capital flows. Capital flows refer to the movement of investment funds across borders. Investors allocate capital based on interest rates, growth prospects, political stability. Strong inflows can strengthen a currency. Outflows can weaken it. Capital seeks opportunity. Purchasing power parity. PPP. Purchasing power parity suggests that exchange rates adjust so that identical goods cost the same across countries in the long term. If goods are cheaper in one country, currency adjustment may occur. PPP is a long-term equilibrium concept. Short-term markets may diverge. Inflation differential. Inflation differential refers to differences in inflation rates between countries. Countries with higher inflation often experience currency depreciation over time. Price stability influences currency strength. Relative inflation matters more than absolute inflation. Interest rate differential. Interest rate differential is the difference in interest rates between two countries. Higher interest rates may attract foreign capital. Capital inflows can strengthen a currency. Interest rate expectations drive FX movements. Yield attracts liquidity. Gross national product, GNP. Gross national product measures the total value of goods and services produced by a country's residents regardless of location. Unlike GDP, GNP includes income earned abroad by domestic citizens. GNP reflects national income more broadly. Measurement influences interpretation. Economic growth. Economic growth represents the expansion of a country's productive capacity over time. It is commonly measured through GDP growth rate. Sustained growth improves employment, income levels, investment confidence. Growth supports currency stability. Global risk sentiment. Global risk sentiment reflects collective investor appetite for risk across markets. When risk appetite is strong, capital flows toward equities and emerging markets. When risk aversion rises, capital flows toward safe haven assets such as government bonds and reserve currencies. Sentiment accelerates currency movements. Fear and confidence influence allocation. Closing. Currencies express comparison, growth, inflation, interest rates. They are not isolated. They interact. Capital moves toward stability, toward yield, toward opportunity. Macro is the architecture behind markets. This concludes Economic Foundations, 6 episodes, 72 structural terms, before prediction, structure, before strategy, language. This has been Lecture -01.